Today we'll highlight the major trends we saw in the 2010 office market. Melissa and I will review each trend and its impact on our local market. This year we again saw a flight to quality as tenants in Class B and C buildings to move to nicer Class A buildings. This helped stem the bleeding for the Class A landlords, but has put more pressure on the Class B and C landlords. As you can see, the vacancy in Class A buildings has decreased 300 basis points from 2010. A good example of this is the Village at Lake Ridge, which was 30% vacant at the beginning of the year and is now fully leased. We see this trend continuing in 2011.
Our second trend is the foreclosure of owner-user buildings. While we have seen very few investor-owned buildings foreclosed upon, we continue to see the small owner-user buildings come to the market from lenders. In most cases, the underlying business is gone and the owner simply does not have the resources to continue making a mortgage payment. These buildings have become wonderful purchase opportunities for those businesses stable enough to buy their own building. Most of these buildings have been in the South Reno area, and we see this trend continuing into 2011.
Our third trend is the federal government taking the lead in office leasing. While you would expect this in Washington, D.C., it also was prevalent in Northern Nevada. ICE, CIS, the VA, the Secret Service, and the FBI all leased large amounts of space in 2010. Only one of these was a build-to-suit, as the GSA put a halt to all new construction. We do not see this trend continuing in 2011.
Our fourth trend is the dearth of investment sales. Major commercial centers such as New Jersey, Chicago, Dallas, and Southern California are seeing a plethora of investors trying to buy their fully leased investments. However, secondary and tertiary markets have little to no activity. In addition, office is probably the least attractive class of commercial real estate, as job creation is still modest. Northern Nevada was no exception to this rule. If not for the foreclosure of the Executive Suite facility on Double R Boulevard and a sale leaseback at 4795 Collin Ranch Parkway, we might not have seen any investment sales in the office market. We think this trend will change as the amount of available commercial real estate in the attractive markets runs out.
Our fifth trend is the expansion of for-profit education. As jobs become harder to find, unemployed and employed workers are going back to school to enhance their skills and their resumes. The Career College of Northern Nevada, the University of Phoenix, Morrison University, and Prospect Education have all either expanded or are in the process of expanding. I think this bodes well for our workforce as we head into the second decade of the new millennium. We think this trend will continue for at least another year.
Our sixth trend is the expansion of green energy companies in Northern Nevada. This year, we saw expansions or relocations into our area by Vulcan, Terragen, and Ram Power. The companies leasing space correlates with the firms that lease geothermal sites from the state of Nevada. With no new significant geothermal sites leased in the last year, we think any expansion will come from organic growth.
Our seventh trend is the lack of ground-up construction. Reno has clearly been one of the hardest hit areas in the nation relative to construction. We have truly become a build-to-suit market. Last year, the only two significant office buildings constructed were the WMS Gaming Building on Technology Way and the building for U.S. Citizenship and Immigration Services on Sand Hill. As we start 2011, there's only one office building under construction. It's a medical office building in Monte Vista Village at 4th and McCarran.
Our eighth trend is the movement of major corporations to higher density offices. This trend is being played out across America. On a recent tour with HP, who is looking to set up a 10,000 square foot consulting office in Reno, the real estate manager indicated no employee will have a private office and all private meetings will be held in conference rooms. He also indicated that unless you need space in the office, you will work out of your home. The long-term effect of this is that even when we get back to full employment, there will be less demand for office space. We see this trend continuing far into the future.
The ninth trend we are seeing in our market is the increase of sublease space. Most of the 5-year leases signed before the start of the recession were more space than companies needed. Until these leases expire in December of 2012, we will continue to see sublease space coming to market. We see this trend continuing for another 2 years.
Our 10th and final trend is the reemergence of turnkey tenant improvements. Turnkey implies the space will be fully built out by the landlord. At the height of our market, landlords were capping TIs in the $25 per square foot range for shell construction. At that time, tenants were having to spend another $25 to $30 per square foot of their own money to finish their space. Today, landlords in some cases are spending north of $30 per square foot on previously occupied space and up to $50 per square foot on shell space to get tenants into the building. The name of the game has become cash flow, and landlords are not letting TI stand in the way of landing a tenant. We see this trend continuing until vacancy gets closer to the 10 to 12% range.
Now let's look at our year-end statistics regarding net absorption for buildings over 10,000 square feet. We ended our 3-year streak of negative net absorption. This amount is very close to our 10-year trend line. We feel this is great news for the office market.
In the garden office segment, we did not fare nearly as well. With another year of negative net absorption, the garden office sector, which is dominated by small local firms, was the hardest hit segment of our local economy. Many of these small businesses simply closed their doors in 2010, leading to the continued loss of occupancy. As you would expect with negative net absorption, the vacancy rate in the garden office segment also increased in 2010. This was tempered by the lack of any new construction.
The vacancy rate in buildings over 10,000 square feet declined for the first time in 4 years. It fell in spite of the fact that we added 2 new buildings as mentioned earlier. Unfortunately, this rate is approximately double the rate of a balanced market. We do, however, like the trend this portends for the future. Regarding lease rates, the larger buildings again saw a decrease in the effective lease rates, but not nearly as severe in the previous 2 years. We think lease rates for this market segment have bottomed out.
The garden office segment also saw the effective lease rate for consummated transactions fall in 2010. While the lease rate for larger buildings may have bottomed, I expect to see another 10% reduction in the lease rate for garden office buildings.
We expect 2011 to look a lot like 2010. I think the shadow space created by tenants leasing more space than they needed prior to the recession will be the largest overhang on our market.
On the garden office side, we expect to see more foreclosures on owner-user buildings. This will continue to create a great buying opportunity for tenants with the means to buy their own building. We also expect to see more startup businesses as entrepreneurs are spawned by the recession.
Lastly, we expect to see a reemergence of the office investment market as money on the sidelines begin to take greater risks to chase yield.
Tim and I wish you the best of luck in 2011 as our market begins its slow recovery.